You've probably heard of Michael Burry, the investor from The Big Short. Well, he's flagged something he sees as a massive problem in the tech world, a potential earnings illusion. Today, we're going to break down exactly what he's talking about and what it could mean for your own investments. Look at that number, $1.7 trillion. Just let that soak in for a second. It's an absolutely staggering amount of money, and believe it or not, it is right at the center of this whole story. So what if I told you that a huge chunk of that $1.7 trillion might be tied to, well, an accounting illusion? That's the big question we're diving into today. The idea that maybe, just maybe, the profits we're seeing from some tech companies aren't quite what they seem. So how on earth is something like this even possible? Well, it all comes down to a really common practice in Silicon Valley, a practice that has some massive and often totally overlooked consequences. It all starts with the high cost of what looks an awful lot like free pay. The term you need to know is stock-based compensation, or SBC for short. And it's pretty much what it sounds like. Instead of getting paid only in cash, employees get shares of the company. On the surface, it seems great, right? It's supposed to get everyone working towards the same goal, a real win-win. But, and this is a big but, here's the catch. When a lot of these companies put out their adjusted earnings reports, the headline numbers that everyone talks about, they treat this stock compensation like it costs them nothing. They literally add it back into the profit calculation, which makes their bottom line look a whole lot healthier than it really is. And this chart right here shows you the result of that little accounting trick. The adjusted earnings that get all the press can be 12 to 20% higher than the true earnings, which follow the official accounting rules. I mean, that's a huge gap. It can paint a really misleading picture of how a company is actually doing. Okay, so the companies look better on paper. Who cares, right? Well, you should, because there is a very real cost to issuing all of that stock, and it hits your investment directly. The first big hit comes from something called share dilution. See, when a company just prints up new shares out of thin air to give to its employees, the total number of shares goes up. That means your shares, the ones you paid for, now own a smaller percentage of the entire company. Honestly, the best way to think about it is like a pizza. Even if the company is making the pizza bigger, your slice is constantly getting smaller and smaller because they keep cutting new slices for other people. Over time, that dilution can just chew away at your returns. Now, this whole situation also sets up another kind of sneaky trap for investors, especially if you use common tools like the PE ratio to figure out what a stock is worth. It creates a classic apples to oranges comparison. This is where you have to be so careful. The trailing PE ratio, that's your apples. It's based on past official earnings, the real numbers that follow the actual rules. But then you have the forward PE, the oranges. That's often just a guess about the future, and it's based on those adjusted numbers that ignore the cost of stock pay. They're just not calculated the same way. So this is why you've got to raise an eyebrow when you hear someone on TV say, yeah, the stock looks expensive now, but look at how cheap the forward PE is. They're comparing a real number with a fantasy number. It's the definition of an apples to oranges comparison. And this whole earnings illusion thing, it gets especially dangerous when the market gets all hyped up about something. Which brings us to the AI froth we're all seeing right now. Let's be honest. There is so much excitement, some might even call it froth, around artificial intelligence. And that excitement is the perfect cover story. These inflated, non-GAAP earnings let companies keep up the appearance of fast growth, even when the real, fundamental business might be slowing down. The hype basically becomes a smokescreen for reality. All right, I know that all sounds pretty bad. But here's the good news. You don't have to fall for it. Let's get you set up with an investor toolkit so you can spot the truth for yourself. The most important thing to get is that none of this is some deep, dark secret. It's not like it's hidden in a vault somewhere. It is all right there in the financial reports. The key is just knowing where to look and what to look for. So what do? It's actually pretty simple. 3 steps. First, always hunt down the GAAP net income on the official income statement. That's the real bottom line, not the fluffy number they put in the press release. Second, watch for how companies are paying people. When a giant like Amazon starts shifting back to paying more in cold, hard cash instead of stock, that's a signal. It might mean their stock isn't the easy sell it used to be. And third, and this is the most important, do your own homework. You have to go beyond the headlines and really read the reports for yourself. I mean, it really all boils down to this.
True diligence means reading the fine print, not just the flashy headlines. It's about taking the time to understand the whole story, not just the convenient summary they want you to see.
Once you really get the difference between those adjusted fantasy numbers and the true GAAP earnings, you have a huge advantage. It's like having a secret decoder ring. It lets you cut through all the noise and hype and lets you make much, much smarter decisions. So, we'll leave you with a question to think about. Now that you know how to spot this potential $1.7 trillion illusion, what else are you starting to see a little more clearly?